can be overwhelming when you start your investment journey, and I won't blame you for that. I was in the exact same situation 4 years ago, looking at English-speaking content around investing just to find out most of it didn't even apply for people in Germany. Don't believe me? Just try to search for the funds that are always recommended, namely QQQ or VOO in your German broker. Chances are that you won't find them. That is why in today's video, I want to share some of the best ETFs for investors in Germany. I'm going to share the ISIN numbers or ticker symbols for the ETFs that I mentioned so that you can easily find the ETFs I mentioned in the video. Hey friends, if you're new here, my name is Ahsan. I'm a researcher, and on this channel we discuss business and personal finance in Germany. As a beginner, you might be wondering, why invest in ETFs instead of individual stocks? Well, exchange traded funds or ETFs are a fantastic investment opportunity that can help you get started with your investment journey. They help overcome the time constraints that you might have, as investing in individual stocks need time to analyze a company's finances and other important variables. ETFs also allow you to invest in a diversified portfolio of stocks without having to individually research and pick specific companies. It's like getting a bundle of investments all in one go. And by investing in ETFs, you can achieve diversification within your portfolio. This means spreading your investments across different sectors, industries, and even countries. It helps reduce the risks associated with investing in a single company and increases the potential for long-term growth. Moreover, ETFs offer flexibility. You can easily adapt your investment strategy by substituting different ETFs that align with your changing financial goals and risk tolerance. Whether you're a conservative investor or willing to take more risk, there are ETF options for everyone. ETFs come in different flavors. Some focus solely on US investments while others explore international markets. And guess what? There are even ETFs that mix both. Okay, now let's get specific with an example. The S&P 500 ETF. This particular ETF tracks performance of 500 of the biggest US-based publicly traded companies. So when you purchase just one share of this ETF, you're actually buying a small piece of all of those 500 companies. Pretty cool, right? To give you an idea, let's say you buy 100 euros worth of the S&P 500 ETF. Within that investment, you would be getting around 7.02 euros worth of Apple, 5.78 euros worth of Microsoft, 2.02 euros of Tesla, and some smaller portions of other companies in the index. It's like owning a tiny slice of these major players. In Germany, you can find S&P 500 ETFs from various ETF providers like iShares, which belongs to the US asset manager BlackRock. There are also ETFs from Amundi, from Credit, from French Credit Agricole, Xtraders, which is majorly owned by Deutsche Bank, and Invesco from HSBC Bank. Now remember, there are various types of ETFs out there. Some track well-known indices like S&P 500, FTSE 100, or the DAX 30. Others focus on specific sectors like the S&P 500 IT sector, and the list goes on. It's all about finding the right ETF that aligns with your investment goals. Let's talk about how to build an ETF portfolio. In Germany, many investors follow a popular strategy known as the 70-30 rule when it comes to their ETF portfolios. Here's how it works. 70% of their investments are allocated to the developed world markets, while the remaining 30% is directed towards the emerging markets. Why this distribution? Well, it's all about covering a wide range of economies across the globe. Currently, most of the growth is happening in the Western world, and the risk is relatively low there. That is why the higher percentage is dedicated to developed markets. On the other hand, the lower percentage is allocated to the developing world. Why? Because these markets hold immense potential for future growth. But as you can imagine, with high growth potential also comes a higher level of risk. However, some investors argue that if they have a strong faith in the Western economies, they might want to adjust this percentage distribution. For them, an ETF consisting solely of Western markets makes more sense. Now let's compare the emerging markets with a well-known US-based S&P 500 index. We can see that there are certain segments where the emerging markets outperform. However, in the recent years, the S&P 500 has outshined the emerging markets. It's important to keep an eye on those trends and make informed decisions. Interestingly, even within the European market, markets, we observe a similar pattern. The S&P 500 has outperformed the German DAX and the British FTSE by more than 100% in the past couple of years, and this trend might even continue into the foreseeable future. So as you build your ETF portfolio, take into consideration the distribution between the developed and emerging markets. Keep an eye on the performance of different market segments and make informed decisions based on your beliefs and risk tolerance. Now let's shift our focus from markets and indices to individual sectors. But before I continue, please hit the like button if you're getting value from this video and consider subscribing. Did you know that there are 11 stock market sectors categorized according to the Global Index Classification Standard? Within this classification, you will find 11 sectors, 24 industry groups, 69 industries, and 158 sub-industries that make up all of the major public companies. Let's take a closer look at the performance of these 11 sectors within the S&P 500 over the past couple of years. We can see that the energy sector was one of the worst performing sectors from 2014 up until 2020. But 2021 and 2022 were amazing years for this sector. But in the past 10 years, it has been the worst performer. The technology sector takes the crown as the best performer, boasting an impressive annualized growth of 18.81%. Now you might be tempted to put all of your money into the information technology sector considering its outstanding performance. However, if we examine the sector performances over the past year, a slightly different story emerges. Surprisingly, the communications sector takes the lead with a growth of 35.51%. Meanwhile, the technology sector has experienced a gain of 29.4% within the same time frame. Here's an interesting insight. As the economy expands and contracts, the financial performances of companies across the 11 sectors fluctuates accordingly. When the economic outlook is positive, economically sensitive companies tend to outperform and investors flock to buy their shares. However, when the outlook looks gloomy, investors may sell out of these companies and seek investments that can better weather economic downturns. This strategy is known as sector rotation. Due to this phenomenon of sector rotation, having a heavily concentrated investment in just one sector might not be recommended for someone with an ETF portfolio. Diversification across sectors can help mitigate the risks associated with economic fluctuations and potentially enhance your overall investment performance. When it comes to diversifying your ETF portfolio, the level of safety you want to prioritize is entirely up to you. As I mentioned before, the technology sector offers more growth potential but comes with higher risk compared to a broader market index like the S&P 500. Now let's take a look at commodities as an example. Some commodities like crude oil are cyclical in nature. Back in 2008, the price was at its peak but fell drastically due to the financial crisis. The prices increased and dropped again, showing a cyclic nature. This shows that in the long term, commodities might not always make as much sense compared to other investment types, especially if you do not have time to analyze the situation. While the 70-30 rule can provide a good guideline, it's important to remember that there are no hard and fast rules when it comes to diversification. You have the flexibility to invest in different kinds of ETFs as long as you understand what you're investing in and the associated risks. You might have noticed in previous videos that I've talked about various investing strategies such as growth stocks, ETF investing, and dividend investing. Currently, I'm mainly focused on investing in ETFs and dividend stocks. If you are curious, you can see my latest portfolio update here. That said, it's important to be adaptable as an investor and adjust your investing strategies as you learn and grow. Now let's dive into the best ETFs for investors in Germany. First up is the MSCI World ETF. This ETF provides broad coverage of companies from all around the globe. With its extensive reach, this ETF offers stability and decent returns overall. Next, we have the MSCI World Emerging Markets ETF. This ETF focuses on emerging markets with a strong emphasis on countries like China, Taiwan, and India. These three countries alone contribute to nearly 60% of the companies in this ETF. While these companies hold great potential, only time will reveal if the potential translates into success. Moving on to the S&P 500 ETF. As mentioned earlier, this ETF tracks the performance of the top 500 500 companies in the United States. While the diversification is somewhat limited, considering the policies and prospects of the US government, companies within the United States are expected to experience faster growth than those in other countries, at least in the near future. Obviously, these are some of my favorite ETFs that I think are the best for investors in Germany. But you can always search for ETFs that fit you better. But for that, you need to understand principles like accumulating or distributing ETFs, the difference between physical and synthetic ETFs, and the total expense ratio, which I discussed in this video. So thanks for watching, bleib gesund, and I'll see you in this video.